I wanted to do a quick video today because this dividend portfolio is blowing up. I'm adding 5 more stocks to my 2019 stock market challenge and I'm already up almost 12% since the beginning of the year. That's 5% over the market return so far, and there's a lot of room left in these dividend paying stocks. We're talking dividend investing today on Let's Talk Money.
Beat debt.
Make money.
Make your money work for you.
Creating the financial future you deserve.
Let's talk money.
Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the community. Thank you for taking a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now, it hasn't even been a month since we started the Grow Your Dough Challenge here on YouTube, but I wanted to finish updating you on all the dividend stocks in our portfolio. These 10 stocks are exploding with the portfolio already beating the market, and one of the picks up from our last video, 32%. Today, I'm going to be finishing out the portfolio, revealing the next 5 dividend stocks. I'll go into the upside on each and then give you a review of the entire portfolio. The portfolio is up double digits in just 2 weeks, so you're definitely going to want to stick around for that. I'll link that first video detailing the challenge and how you can set up your own portfolio in the first comment below. Make sure you check that out because I shared what I'm looking for in these stocks and the first 5 picks to the portfolio. To track my portfolio of dividend stocks, I'm investing $1,000 on M1 Finance, a no-fee platform that lets you pick your stocks and automatically invest any new deposits across the group. Unlike some of the other investing apps, M1 doesn't charge a monthly management fee, which is why I'm using it for this no-cost investing strategy. It also has retirement accounts available, something Robinhood doesn't have, and that's extremely important anytime you invest in high-yield stocks paying dividends. What's great about this year's stock market challenge is that we've got 14 other YouTube channels participating, all taking a different perspective on investing and tracking their portfolios for the whole year. And there are some heavy hitters in this group. David over at From Military to Millionaire is doing a flipping strategy and has already made some returns that are going to be hard to beat. Tila Holcomb is picking from her swing trading portfolio, and Jeff Rose is tracking 9 different investment accounts, which actually sounds exhausting, but he's a hard charger, so good for you, Jeff. I'm leaving a link to their videos in the video description below, so go check out what they're doing. But let's get to those 5 dividend stocks I added to the portfolio and why I think these could be some of the best investments of the year. Our first dividend pick is one of my favorites and already up 17% since we added it to the portfolio. Hanes brand, ticker HBI, is a leader in activewear and apparel globally and pays a 4.3% dividend yield. Now, the company is either first or second in nearly all its product categories with some world-class brands. The US activewear category is growing at 3.2% annually versus sales growth of just 0.7% for all apparel, so the company is definitely positioned in the right space. International sales grew from just 11% in 2013 to nearly a third of total revenue and continue to expand higher. Consumer direct sales, so the company's online presence, is now almost a fifth of total revenue, which gives it a big runway for higher profitability. Now, debt has really been the problem over the last few years, sending investor sentiment plunging, and the shares are down more than half since 2015. Management expects to be within that debt to earnings range this year, though, and that could bring back the share repurchase program. Management is targeting 25 to 30% payout ratio, one of the key factors we talked about in dividend safety in our last video, so definitely some profits available for growing the company. Now, shares are trading for just 8.3 times earnings on this one, about a 25% discount to the average price multiple for competitors in that apparel space, and a dividend payout that's twice the market. My next dividend pick is General Mills, ticker GIS, a leader in just about every one of its product categories. The company controls nearly a third of the cereal market, 18% of domestic yogurt market, 50% of baking mixes, and 40% of the grain snacks market, and it could be about to corner the pet food market with its Blue Buffalo acquisition. Management is expecting a 10% sales growth this year, aided by that acquisition, which is huge for a food company. Operating profit is expected up 9%, and the shares pay a 4.7% dividend yield. Blue Buffalo is a market leader in the pet food specialty channels and the e-commerce channel, but still only accounts for 7% of U.S. retail pet food sales. That means there's a lot of upside for market share gains once you combine it with that General Mills distribution and marketing. In other products, the company increased its market share by 0.7% to a record 31.6% in cereals last year, and the yogurt market share increased in Q4 for the first time since 2017, so some very positive trends in these categories. General Mills has improved profitability with an increase in the operating margin of 1.3% since 2015. That's a move that has saved over $1.6 billion, with another $700 million in savings expected. Now, besides that dividend yield that's more than twice the market average, the company has decreased its share count by 12% over the last 5 years, helping to grow the dividend by 8% annually. Shares trade for 13.8 times earnings, which is very low for a consumer staples company, so lots of value and dividends on this one. Now, I'll have to admit that my next dividend pick is a little boring. PPL is a regulated utility company with customers in Pennsylvania, Kentucky, and the UK. Now, I'm putting this one in the portfolio on some really solid fundamentals and an excellent 5.5% dividend yield, but also because I wanted something from the utility sector in case the rest of the market hit a speed bump this year. I'm not expecting as much out of PPL as others in my portfolio, but it's going to save my butt if we run into trouble. Relative to other utilities though, PPL is a great dividend stock. Management has affirmed its guidance on 5 to 6% earnings growth through 2020 and a 4% annual dividend increase. Projected rate increases are above 5% through 2020 and double-digit growth coming from Pennsylvania transmission. Even on the worries around Brexit, UK customers are still going to need electricity, so I think the stock has suffered too much. It's down 20% since that first Brexit vote. The Bank of England certainly isn't going to raise rates anytime soon, and that's a positive for this stock. PPL is planning $430 million in capex savings through 2020 in a move that's going to support that cash flow and dividends. The shares are trading at 12.3 times earnings, which is a 23% discount to the average multiple for utility companies. Our next two dividend picks are going to be funds, adding to the Vanguard Real Estate Fund and the Alarian MLP Fund we covered in our last video. I talked about Chinese stocks in the last video, adding China Life, and it's now my second best performing company. Here I'm adding the iShares China Large Cap Fund, a fund holding 50 of the largest Chinese companies trading on the Hong Kong Exchange and paying a 2.7% yield. And I talked about the upside to Chinese stocks in our last videos. I truly believe that this could be the best opportunity in a generation to pick up these stocks. This could be China's century, and you need exposure to these companies. Neither President Trump nor President Xi want a trade war, and in fact, we're getting headlines last week on some major movements in the negotiations. The FXI fund is overexposed to the financial sector with 46% of holdings. A part of that is just because financials are some of the largest companies and were some of the first to enter the markets. Another 20% of the fund is in communications and tech companies, while another fifth is in energy and real estate. Now, I've actually preferred some of the more diversified China funds like the S&P China GXC fund, but here I like the FXI better, and I'll tell you why. The government is coming out with some major economic stimulus this year. They already made the largest capital injection into the banking system in history. They're lowering bank holding requirements and coming out with some major tax cuts. Now look, China is a command economy, meaning if the government wants the economy to grow at 6% plus, it's going to do what's necessary to make that so. It's going to use some of that massive $3.5 trillion in foreign reserves, and everything else is in its power to drive that economy. Banks are going to be the first to benefit from that stimulus because it's the most direct. Overall, stocks in the China fund trade for 10.4 times earnings, almost half the cost of U.S. stocks, with an average price to earnings of 20.5 times for the S&P 500. Now, the other fund I'm adding is the iShares Europe Financials, ticker EUFN. It's a fund holding 80 stocks in the European financial sector. Now, this one has been the laggard so far with a return just under 5% since I started the portfolio, but I really think this could be the surprise of the year. The fund pays an amazing 6.5% dividend yield and trades for a price of just 0.9 times book value. That's a 30% discount to the 1.3 times book multiple on U.S. banks, and the shares are off their high in 2018 by 28%. We talked about the upside to U.S. financials in our last video. In fact, in that portfolio review next, one of our community bank stocks is up over 30% already, but there are some solid plays in Europe as well. Now, a third of the fund is in UK-based banks, but that doesn't necessarily worry me. Shares are trading around the lows reached after that first Brexit vote, so I think they're pricing in for the worst possible outcome. About half the overall fund is in European banks, with another third of the holdings in insurance, and the rest are in diversified financial companies. Solid economic data now has the markets expecting a first rate hike in years to come this September before ECB President Draghi finishes his term. This, combined with slowing rate hikes from the US Fed, should support the euro and drive rates, which is going to be really good for profitability at European financials. Now that we have all 10 dividend stocks in our portfolio, I wanted to review how it's done since funding on January 4th. I bought $100 worth of shares in all 10 companies and funds for $1,000, and it's now up 11.5% in the first 3 weeks. That's almost double the return on the S&P 500 and more than double the Vanguard Dividend Appreciation ETF over that period. China Life and Hanesbrand were the standouts until last week when Bank OZK stunned Wall Street with earnings that beat expectations by 7%, as well as a solid beat on revenue. Shares of the bank jumped more than 10% on Friday alone and are up almost 32% since adding them to the portfolio. In fact, from the day I started the portfolio to last Friday, every one of the 10 dividend stocks was beating the stock market. 3 of the funds are lagging the individual stocks, but I like having them in the portfolio for that diversification. I'm updating the portfolio with a new video each month, so make sure you subscribe to the channel and follow the stocks. I'll leave that link to the first video in the comments below so you can see how we added those first 5 stocks. You can also set up your own dividend portfolio through M1 Finance with the link I'll leave in the video description below. We're here Mondays, Wednesdays, and Fridays with the best videos on beating debt, making more money, and making your money work for you. If you've got a question about money, just subscribe to the channel and ask it in the comments. We'll make sure you get an answer in a future video.